In this video, we cover some significant changes we have made to our day-to-day approach to the markets. While the content is for CCM clients, it still may be of interest to readers of short takes, since it will put some context around future market comments. I'm going to move through these first two slides fairly rapidly because I want to get to some more concrete examples. Obviously, when you're making changes to your systems, you want to improve your investment performance. We want to be able to adapt to what we term as centrally planned markets. There's increased frequency and magnitude of intervention in the markets. It's a reality. It's something that we have to adapt to. We want to increase our holding periods. We'll show 2004 and 2005 as an example of why that's important. Most of us know that the longer you hold an investment, the higher the probability that it will be profitable. We want to be able to react more rapidly to what we term as meltdown and melt-up markets. The meltdowns that we've had in the last 2 years, think of the flash crash in 2010. And in 2011, we had a meltdown related to the downgrade of U.S. debt and the problems in Europe. The melt-up side of the equation here comes from the intervention from the central bankers when they pump up the financial system. We also respect that any investments made today need to account for the fact that despite the quote-unquote improvements in Europe, there are still significant and substantial risks in the financial system. Probably the most significant change that we're making is this right here. We're adding what we'll term as a daily sign-off. We're going to sign and date a report every day. We're going to show you a sample of what it's going to look like here in a minute. We've tightened up our asset allocation rules. We've simplified our systems and our model outputs. One example of that would be we've scaled all our models so the output goes between 0 and 100. We've also consolidated our models so they put out one figure, one number that we can look at quickly. We also needed to add a faster model to our stable. Our original models, the Bull Market Sustainability Index and the 80-20 Correction Index, were purposely made to help and assist in long-term investing. And they really weren't tailored to the environment that we've had, the melt-up, melt-down environment that we've had. They're still good systems. We just need something that reacts a little bit more rapidly to, let's say, central bank intervention. One of the main reasons why we want to do the daily sign-off is we want to play our Moneyball lineup. For those of you that haven't seen it, Moneyball is a movie about statistical analysis that was used by a Major League Baseball team, the Oakland A's. The Oakland A's were one of the first teams to use statistical analysis to evaluate, draft, and build a team. And in the early stages of the movie, the general manager does his statistical homework. They build their team. But early in the first season of using that strategy, the manager doesn't play the Moneyball lineup. He doesn't play the players that the general manager wants him to play, and the Oakland A's get off to an awful start and are in last place. Later in the season, the GM finally forces the manager to play the Moneyball lineup. All the work that they did in statistical analysis finally is put on the field, and in that same season, the Oakland A's went on a tear and set an American League record for consecutive wins. The analogy for us is if you have the best market models in the world and have done a tremendous amount of research, it's not very helpful if you're not using that research in a consistent manner. This is an example of a report that we're going to generate every day. This is kind of a prototype. But one of the most important things is we're going to have to review this every day and sign off on it. As most of you know, I work full-time with my wife, Kathy. We're going to produce this report, and both of us are going to sign and date it. We're going to keep it. We're going to have clipboards right behind us with the reports. We're going to put them in 3-ring binders so we can have a history. So every day we're going to look at our profile for the market, allocations. We'll look at market leaders. These are ETFs that come from our models here in the middle. Down here, you can look at our market models in terms of trends, How are they changing over the last 5 days over here? And then just some simple things like, how is the S&P 500 doing relative to its 200-day, 50-day? Is the 50-day over the 200-day, etc.? So tightening up discipline for markets that require harder and tighter risk management controls. As I mentioned earlier, I believe that this report and this increased discipline will be more important than any new market model that we build or any statistical analysis that we do. This is the most important thing that's going to help us improve performance and adjust to markets that are increasingly volatile. Let's set the stage here for what we're looking at. This is the S&P 500 index. This is 2007, 2008, and the beginning of 2009 over here. What we're looking at, this is 200-day moving average. That's the 50-day moving average in blue. And this is the S&P 500 in black. What we're looking at here is the result of weeks and hours of work trying to improve our systems, and we're extremely excited and pleased with the results. What we've done is we've taken the Bull Market Sustainability Index, the 80/20 Correction Index, and we built a faster risk model. And then we built a new asset allocation model that takes the input from those three models and gives us one number. We've got everything down to one number, which is exactly what they did in Moneyball. They took player evaluations down to one number. They could put one number on a player and evaluate the situation. We can put one number on a market and get an excellent idea of how much risk we should be taking. So this 92 here tells you that our output is recommending here in the fall of 2007 that you have an exposure of 92% to risk. So think of it this way. If you had an aggressive account, that might mean that you're 92% in stocks and 8% in cash. That can vary from client to client, but the 92% can still be used as a guide for everybody. It may never be appropriate for some clients to be in 92% stocks, but it still can help us ratchet up their exposure to risk or ratchet it down. And these are what I'll call hurdle models. And the models do use the 200-day and the 50-day. So if you think about a step in, step out hurdle model, when you begin to step out is when negative things happen. One negative thing could be the 50-day moving average turning down here. Another negative thing could be the 200-day turning down. A third could be the cross of the 50 and the 200. The more positive things you have over here, the higher your allocation can be. The more negative things you have on this side, the lower your allocation can be. The takeaway for us is the output is excellent. What it does is it steps away from risk. It's got you at a point here where you're pretty well invested up here. It's noticing that the market is starting to deteriorate, and notice how rapidly you step away from risk. And the best way to sum it up is from this point here, here, and down here, from here to here, the S&P 500 dropped 53%. The average exposure to risk that the model is recommending is only 15% here, which is excellent relative to the recommendation of a 92% weighting here. It's extremely important to note that it's a step-in, step-out model. And what I mean by that is you're not making a move, staying at 5% all the way here and then moving to 60. What it is you're generating the report every day. We're signing off on the report with that number. And incrementally, you're moving from 5 to 60 here. So hypothetically here, you could be at 30%, 40%, 50%, 60%. Then here, you're backing off 50, 40, 30, etc. And the model tends to move rapidly when things get bad. It moves less rapidly when you're in more favorable conditions, when price is above the 200-day, etc. When you get down in this area, it can back away from risk rapidly. Similar concepts here. Here's the March 2009 low, This is 2010, so now you're seeing a transition from a bear market to a bull market. You can see here, if you know your market history, there was a pretty big rally off of the November 2008 lows. It allowed us to participate that a little bit and step in, but not too much because you're still in a shaky environment. The 35 here is then stepped away. You end up with a 5% allocation to risk. So again, think of 5% in stocks, 95% in bonds or cash. Then we step back in, and you'll notice as we get above the 50-day, this slope turns up. It allows for the steps to be fairly large. You move from 13 to 60 fairly rapidly. Here, the market and the models and all of the data that's behind this one number are starting to recognize that the market internals are improving. So the allocation actually increases here. Then when we get into full bull mode, you can move even more rapidly. We're at 62 here, and it doesn't take very long to get to an 85% allocation. You can increase all the way to 100 here, and we stepped away from risk fairly rapidly here. This is a pretty big correction that took place in 2010. We only took the risk allocation down to 67 because you've still got an upward sloping 200-day moving average, price above 200, and the market internals reflected in the gobs of data that are behind this. And I'll show you a spreadsheet that produces this one number in a moment. But very excited about the way this is working. This is a huge competitive advantage for us going forward. And using the new discipline systems that we have, that we're signing off on these things every day, it's going to be nearly impossible to miss a significant turn in the markets, whether it's bullish or bearish. Now we're looking at the end of 2010 here. This is 2011, right up until the present day. The takeaways here are, notice if you use an overly simplistic system, and I'm not saying there's anything wrong with a simplistic system, we use the 200-day and the 50-day as overriders in this model. So simplicity is excellent. However, notice here, if your model was based upon the slope of the 200-day turning over and the 50 crossing the 200, this whole plunge took place here. The slope of this 200 has not turned over yet, and the 50-day has not crossed yet, meaning that type of model would have stayed invested in here. And notice what our new model does when we're in a fairly healthy market here, which is price above a 200-day, 50 above the 200, the slope of the 200 moving higher, etc. These numbers are relatively high. In fact, if you take the average of these numbers that I'm circling here, the average allocation there was 83%. When we get into this region here, which is an unstable and unhealthy market, the average allocation below this 200-day was only 32%. And that's good risk management. You can make an argument that you should have held all the way through this. I'm not comfortable doing that. This is a very unstable global financial system down here, and the facts are that if they don't print gobs and gobs of money in Europe, this market's going to go lower. So to buy and hold through this, if you really understand the risks in the financial system, and if you watch some of my videos about Europe, I think I know the situation in Europe and the situation relative to global debt about as well as anybody that sits in my chair. The risks are real, and they will probably return. So very happy with the way the model handled this. You can see we were able to step away fairly quickly. Never really got to a crazy allocation up here, and then when the market became more stable, this is where they print the money. This is interesting on how risk changed, and it gives you an indication of the amount of math and numbers behind this. We were able to move from a 35% allocation to a 60% allocation literally in one day. This is December 19th, this is December 20th. And this was when they released the results of the unlimited 3-year loans, the first round of them. And then we were able to step to 69 in here pretty quickly and eventually get to a very good allocation in here. You're already at roughly 80%. Came up here, we're roughly fully invested, and now the models have incrementally stepped away. We were as high as maybe 99 up here, then we went to a 90, then we went to an 83, popped back up, and now as of yesterday's close, or today's close, I should say, on the 10th, we're at 85. And we don't have an 85% exposure to risk right now. So if we're going to follow the disciplined approach, it says that as this market comes down, we would reduce our exposure to the market and to stocks if the model tells us to. If it doesn't tell us to, we're going to stick with the disciplined approach. And why do you do that? Well, we'll look at 2004, 2005. You mainly do that because when you've got a market that has an upward sloping 200-day, an upward sloping 50-day, price above a 200-day, that tends to be a healthy market that goes on to make higher highs. Limited exposure to risk, just stating it again, down here it's saying roughly your target allocation would be an 8% exposure to stocks here and a 92% exposure to either cash or very conservative investments like bonds. In this region here, you can see why it's so important to go to the Moneyball lineup approach and the sign-off on the reports every day. Look how fast this plunge came in, and this could happen again. We could see this over here. We still have systemic risk that could return if bond yields continue to rise in Europe, and you can see from the models if we need to step away and sell the positions that we have now, we'll do that. If you're signing reports every day and looking at this, you're going to see that the trend is deteriorating rapidly, that we've gone from an 88 here to a 65 here, and you're on the ropes. The report also will tell you when this is flattening out, when this has a negative slope. And things happen so quickly now that if you don't have time anymore to stop and look at 50 charts every day to try to make a decision. Things happen so fast that you've got to get your systems down to one number like this where you can make an intelligent decision with a lot of data behind it and do it within hours. It could be from an open to a close. It could be from a close to an open. This will give you a little bit of an idea of the complexity behind the numbers, the blue numbers that we originally looked at, where we saw the recommended asset allocation. So if there was a 92, what did that mean? What this is complex, but it's simple. There's really no human interaction with this. We don't need to do anything. It's all automated, and it does the calculations for us. What you're really looking at here is this is an individual date. It pulls the risk score and the 80/20 and the BMSI from other spreadsheets. It calculates a composite score. And then to get to this recommended allocation to risk here, it compares this day to all kinds of historical data down here. The zeros and the ones are answers to questions. A 1 is a yes, a 0 is a no. And you can get an idea of how easy it is for us to take one day and quickly analyze it in numerous ways to try to get an idea of the risk profile of the market. And I'll try to scroll through this a little bit faster here, but it just gives you an idea, and we're not even down to the bottom yet. And again, no human interaction required here. This is all automated. These are the overrides for the allocations here. And this doesn't even give you an idea. There's another slew of charts and spreadsheets that go into getting this risk number, this 80/20 number, and this BMSI number. So when we show you those blue numbers on the charts, there's literally years of research, because we built the BMSI 2 years ago and the 80/20 roughly 2 years ago, and there was hours and hours and hours of work done. There's nothing wrong with those models. They work great. This new risk model just works a little bit faster. I understand this is a very noisy chart. Really what we want to focus on is this volatility of price here. We're looking at the S&P 500 are these colored lines, 50-day, 200-day. The point of the exercise here is this is 2004 and this is all of 2005. Look how volatile these markets are. And look really what happened. Market starts here, volatility the whole year, and then finishes higher. Market has volatility pretty much the whole year and finishes higher. The only way you can make money in this environment is to have a model, and this is why we looked at 2004, 2005 as one of the cases to build the model, because we've got volatile markets today. You've got to keep a core part of your allocation at least intact to try to make it from point A to point B. Try to make it from point A to point B. And that's why it's important, even in the present day, that if the markets start to come down here, that we don't panic and go to 100% cash, because our objective is to make it from point A to point B. And given what we know as of the close on April 10th, we're under allocated right now. We have too much cash. So unless the market's profile deteriorates to a point where we need to raise even more cash, we should be thinking about adding on weakness to our allocation. And we don't need to know what's going to happen. We just need to pay attention to what is happening and what the models are telling us. If you just want to know what this is, these are scores of our models, and we use this and many other charts like this to help do the programming in Excel for the models. This is our risk model. This is the bull market sustainability index in blue. This is the 80-20 correction index in green. And this 85 is a composite index of these three. Just to give you an idea of some of the other charts that we looked at and the level of detail and why we've somewhat had radio silence and not been posting on short takes as much. We've just had our head down doing this analysis and this programming. This is 2003. These are market values. This is 2004 that we just looked at. This is 2006. Each of them a little bit different. 2007. These orange lettering here, these are classifications that we have. This is a peak in a weak market. This is a pullback in a relatively healthy market, etc., etc. And we've got some other models that we've built and are still building in addition to the core model. This is 2008, some of the key days that we focused in on. 2009, the transition back to a bull. You've got 2010 and your volatile flash crash in here. You can learn a lot from this here, how fast the markets are moving. And last year's escapade. And notice the amount of analysis that was done here, because it was a crazy period and a crazy time, and we can learn a lot from it. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.